Hello friends, welcome to Oliveboard. In this video, we will learn about GDP, GNP, NDP and NNP and look at the differences among these four terms. This is a high scoring topic of Indian economy. So let's start. Please subscribe to Oliveboard's YouTube channel to never miss latest videos. And if you are already a subscriber, please hit the bell icon so that you will get all the latest updates. So, what is national income of an economy? National income of an economy is the monetary value, okay, in money terms, which a country produce in total. Okay, so national income of a country or an economy is produced or is expressed in terms of GDP, GNP, NDP, and NNP. So these four terms constitute national income of a country. This is a keyword. Okay, now we will come to the most important point or topic here, which is gross domestic product or GDP. GDP is the monetary value of all finished. First keyword is finished. No intermediary goods or no raw materials are taken into picture. So all the finished goods and services. So both goods and services are being taken into picture. Produced within countries' borders. Okay, produced within countries' borders in a specific time period, usually a year. Okay, so we see things yearly, like a financial year. Okay, so which starts from April 1 in India. Now, within countries' border, this thing has a special significance here, because this creates a difference between GDP and GNP. Okay, so within countries' borders is GDP, right? Countries' borders or boundaries. GDP includes all public and private consumption, because all public and private consumption has a monetary value. Exports are added to the GDP and imports are subtracted from the GDP. Now this is important. Obviously, if we are exporting something, we are producing something in our country, okay, and that thing we are exporting. Suppose if it is a finished product, suppose we produce handicrafts in our country and we are exporting it to USA, we will have to include in our GDP. But if we are importing something from another country, suppose oil we are importing from let's say UAE or Saudi Arabia or Iran, that we have to subtract, obviously, because we are not producing it in the boundaries of our country. GDP is a measure of country's overall economic strength. So we follow GDP as a measure of overall economic strength of our country. Now the basic question, does GDP include the output? It's a logical one. Produced by foreign corporations or foreign nationals within the boundaries of the country. Does GDP include? Will it include? Yes. Because as per the definition, within countries' border, anything which is produced, no matter what, no matter if it is being produced by Indian company or a foreign company or Indian nationals or foreign nationals. In India, GDP is calculated on an annual basis and also on quarterly basis. So quarterly predictions come, quarterly GDP predictions come if you see the newspapers, okay, as per the quarters. Now GDP includes four main components, right? GDP includes four main components: private consumption, which is being consumed by us consumers, then government expenditure, investments, and foreign balance of trade. What is foreign balance of trade? Foreign balance of trade is exports minus imports. So net exports. Okay, it can be positive also or it can be negative also. So if our imports, like in case of India, import is more and export is less, so it will always be negative, right? Then there are three methods to determine GDP. This is important. You should know the name of the methods and the basic concept. That's it. Nothing more, nothing less. So GDP based on expenditure, GDP based on output, and GDP based on income. Expenditure, what we are spending. Okay, what is the expenditure? Total expenditure. output, what is the total output or what is the total production in terms of finished goods, and what is the income within the boundaries. Okay, now GDP based on expenditure takes into account expenditure by different factors of production or by different sets of people. So this is a formula for expenditure approach: C plus G plus I plus EX minus IM. So C is the consumer spending, G is the government spending, I are the investments which are being put by the government and the consumers, EX exports, and IM imports. So this is net export, right? So this is the formula. Now GDP based on output, it takes into account total value of economic output. Economic output means total goods and services produced. This method deducts the cost of intermediate goods that are being consumed in the process of producing final goods, because it leads to double counting. So if we are counting final product also, and if we are counting intermediary goods being used in the production of final good, that means we are counting intermediary goods twice, so which leads to a thing called double counting, which we have to avoid at all costs. Otherwise it will be a it will not be a correct picture of our economy. Now GDP based on income, this method of calculation of GDP is based on income earned in wages, income earned from land, profits from business. So all the factors of production line, land, labor earned wages, businesses, okay, like this, or entrepreneurs. Now this method is most commonly used, so please remember it. Now question: which of the following options is not approach to calculate GDP of an economy? We have just read. Expenditure approach is one, income approach is one, production approach or output approach, output or production, we can call it production approach also. So this is the answer. Which of the following is not an approach? So raw material approach is nothing. Now nominal versus real GDP. Nominal GDP is not adjusted to inflation, simple, while real GDP is adjusted to inflation. So in a normal case where the GDP is where the inflation is positive, obviously in case of most of the countries inflation is always positive because countries are growing and the rate of things is ever increasing. So inflation is positive, that means nominal GDP is always higher than the real GDP, because the effect of inflation will lower down the real GDP. Now what is the effect of positive GDP growth on inflation in a normal scenario? Positive GDP growth on inflation. If GDP is growing, if in a normal scenario, if GDP is growing, what happens to inflation? Okay, if GDP is growing, that means consumers are spending more, government is spending more, wages that we earn are more. That means in general inflation is increasing, inflation will increase, okay, in this scenario. In India, GDP is calculated based on three broadly classified sector: agriculture and allied sector, which we call as primary sector; industry sector, which we call as secondary sector, which uses primary goods to produce finished goods; and service sector, which we call tertiary sector. Now which of the following is a base year for the calculation of GDP in India? An important factual question, a current affairs question, and the answer here is 2012. Previously it was 2004, 2005, now it is 2011, 12, and GDP is being published by Central Statistical Office, MOSPI, Ministry of Statistics and Program Implementation in India. So this point is also important. Now GDP is measured in rupee terms, but GDP growth is measured on year-on-year basis in terms of percentage growth. So GDP, like for India, we have in USD terms on a global level. Obviously, if we are speaking on a global forum, we have to express our GDP in terms of USD, US dollars. So 2.86 trillion approximately. This is the value. Now if you multiply it by say 70 rupees, you will get the GDP of country in rupee terms. Okay, now suppose, let's say this is our GDP. So let's say 2 trillion, for example, was the GDP in 2017-18, and now 2.2 trillion is the GDP next year. So 0.2 by 2, so 10% increase in GDP. So that's how we project the increase or GDP growth rate in terms of percentage, which we normally see in newspapers and other media items. Now, gross national product, GNP, is the total value of all final goods and services produced by countries' residents. This is the key term here, by the resident domestically or in abroad. So this GNP, it includes domestic production also within the boundaries of a country and outside the boundaries of a country. So if somebody is working in let's say Dubai, if somebody is working and he is earning some money, that means it will be counted. Okay, GNP include income earned by Indian residents abroad. GNP doesn't include income earned by foreign nationals in the country, within the country. Okay, within the country. So GDP was including this figure by foreign nationals, earned by foreign nationals, because it was inside the boundary. Now this is not including. So GNP is GDP plus country's residents income abroad minus foreign nationals income earned in country. So this you should remember, this formula. Difference in GNP and GDP figures. Now GDP is being used to assess national income. This is very important. But why GNP is used? So for international trade, to determine the level of international trade, growth in international trade or decline in international trade. Basically, we will need GNP also for some other purposes. Now, net domestic product, annual measure of an economic output of a country adjusted to depreciation. Simple. So GDP and GNP, we know now. Those are the most important topics, most important concept, GDP and GNP. Now net, wherever net comes, okay, it is adjusted to depreciation. Simple, you remember depreciation and net. Now net domestic product is GDP minus depreciation. Simple. Okay, so obviously net domestic product will be lower than GDP. Now, because many assets and capital goods, there are many capital goods like machinery, use vehicles, and there are other things, also flats, houses, they are depreciable in value. They depreciate in value. They are depreciable, depreciatory nature, such as machinery and vehicles. So NDP is useful as it tells about the pace at which capital goods degrade and must be replaced. Now, net national product, again NNP, GNP minus depreciation. Simple. So you should by this one simple sentence, you know what net national product is and what net domestic product is. Now I am introducing you to a new concept which many of you might not know: gross value added. Okay, this is an important concept, guys. Gross value added. It is a concept by which the value of final goods and services produced in an area or industry or sector of an economy is measured. Okay, it is mostly it is similar to GDP, but it is sector specific. Okay, in a sector of an economy is measured. So piecewise GDP. GDP is linked to GVA is linked to GDP. GVA is GDP minus taxes on products plus subsidies on products. Now GVA is sector specific, and GVA provides an economic picture from products side or supply side, whereas GDP provides from consumers perspective. Okay, so this is what GDP is. GVA provides rupee value for the amount of goods and services produced in an economy after deducting the cost of inputs and raw material. GVA gives a picture of economic activity from producer side, which we have already discussed. So sector wise, like we have many sectors: agriculture sector, we have health sector, we have education sector, we have auto sector. Okay, then we have IT sector, then we have let's say consumer durable sector. So there is some GVA for auto sector, there's some GVA for IT sector, some GVA for pharma sector. So sector wise, and if we add all the GVAs, we will get GDP in a way. Okay, so I have a question for you guys. Read the following two statements. National income is the monetary value of all the final goods and services produced in the country, and net value is obtained by deducting depreciation from gross value. So which of the following statements is or are correct? Statement 1 is correct, 2 is also correct. So none of these cannot be the answer. The answer is both of these. And second question, which is related to the current affairs, which is in trend and which might be asked again, an important question. So according to IMF, what will be the India's GDP growth forecast for financial year 2019-20? Is it 6.2%? No, this is for China. China's growth forecast. 7.0? No. The answer is 7.5% for 2019-20. So these kind of questions have been asked in exams like RBI, SEBI, SBI PO. The forecast in terms of IMF, World Bank, or RBI, you can say Ministry of Finance. Okay, so this is 7.5% for 19-20 and 7.7% for India 2020-21. Okay, financial year 20, we name it as FY20. So India is the only growing company, the fastest growing country in the world. This data is being produced by IMF in its flagship report called World Economic Outlook. So you must remember this name. This is very important. World Economic Outlook is published by IMF. That's it. World Economic Outlook is published by IMF. So guys, I hope you like the video. Please push the like button, share the video among your friends, and subscribe to the channel. All the very best.